Hi, this is Jack Schwager. In this video, we will illustrate 9 different approaches to using the trend weight. It should be noted that the same approaches would apply to the directional weight as well. There are a couple of differences between the two, and at the end of the video, we'll note the exceptions which apply to the directional weight, but we will only review the examples for the trend weight. We will use the same market, specifically the Australian dollar, for the past 2 years to illustrate each of the approaches and to compare them to each other. And this first example is the simplest approach, namely just using the trend weight with a zero line. That is, anything above the line, namely a trend weight that's positive, would give us a buy, and anything below the zero line will give us a sell. So just to walk through it, here we get the trend weight falling below zero, we get a sell, we get it back above zero, we get a buy, below zero, sell, pretty much sideways here, going on to the next page with a buy that's carried over, up to this point where the trend weight falls below zero, we go neutral for a day and then short for the rest of the period. So that's the basic simple approach, just essentially continuously long or short, with the simple exception where the trend weight is exactly at zero, which doesn't occur often and doesn't last very long. In the next variation of the trend weight, instead of using a simple zero line as the buy and sell division point, we define a threshold that is required before a buy or sell signal is indicated. Here we're using an illustration of a threshold at 20. So we get above 20, we get a buy. We get below 20, we enter the neutral zone. We get below minus 20, we get a sell. And so you can see here, we stay short until we get back to minus 20. Then we enter the neutral zone, we get a buy. Neutral again here as we enter plus 20. Short as we go into minus 20. Here we get the line above plus 20, so we're long again, carrying into a long trade, which carries for almost the entire half period here with a very short sideways pattern that's caused by this little dip into the neutral zone here. And then we get below minus 20, giving us the sell, which stays basically short for the rest of the duration of this chart. We can change the behavior of the trend weight with a neutral zone by changing the level of the threshold used in the approach. And in this particular example, we've gone to a much more restrictive threshold of 80 instead of the 20 we used in the previous example. And going to a wider threshold actually has 3 effects, all of which you can see in this particular slide. First of all, you will liquidate out of existing positions much more quickly. So as we go above the minus 80 level in this short position, we get out here, so relatively early in the reversal. The second effect is while you get out more quickly out of existing positions, when there's a trend change, you also get into new trends more slowly. So we don't get long until we actually get the trend weight, in this case to go above 80, which is here. And the third difference is you'll get much broader and more frequent neutral zones by using a wider threshold, as you can see in this particular slide. Here we have basically one longer duration and significant profit short, and 2 smaller duration trades, which are both more moderate losses. And following into the next period, here during this trading range, you basically are either long or neutral without much effect on equity here. And then we enter this one period where you do get short and stay short throughout the duration. So that's the same approach, but again, just using a threshold of 80 instead of 20. Our next variation is the early exit. Now with this version, you'll need to bring up the properties box, go to formula, and check the early exit box. You also have to indicate the threshold. Now in this example, we'll continue to use the 80 threshold to compare it to the trend weight with a threshold of 80, with the difference being that this time we've checked the early exit box. So let's take a look at how that changes the behavior of the system. When you have early exit, essentially you're getting short when you go below zero and long when the trend weight goes above zero. However, as the name implies, you get out much more quickly, specifically at the specified threshold. So for example, let's pick it up from here. You go short when the trend weight goes to zero, below zero. And then as soon as the trend weight gets above minus 80, you exit. So you get a fairly, as the name implies, early exit. You go long when you get back just to the zero level. And again, we get out of that long when we go below 80. Here we drop below zero on the trend weight. We go short. We get above minus 80. We go neutral. The next trade, which carries on to the next side, is long. And we go to the next page. Basically, that long continues. There's a brief period here where you're back to neutral as the trend weight dips below the plus 80 level. And again, you're neutral as we dip below 80 here. And finally, once we get to zero again, you go short, and that's where we are for the rest of the duration of this chart. Our next variation is the early reversal. Now, for this version, we need to again bring up the Chart Properties dialog box. Go to Formula. You can see it's last checked at early exit. Now we would uncheck that and instead check the early reversal. We again use the threshold of 80 so we can compare this version to the other versions we've been looking at recently to see what the effect of early reversal is on trading signals. Basically, with the early reversal, you're getting signals on crossovers of the threshold. So for example, on the short, if our threshold is 80, you're reversing from long to short at actually the plus 80 level when the trend weight is actually pretty high still, but dropping down. It's the movement, the direction of movement that's important here. So dropping the trend weight dropping below the 80 gives you the short. That's the early reversal, and you basically stay short until you get the trend weight going above the minus 80. Again, an early reversal from short now to long at the minus 80 level. So we're still in deep negative territory, but we're going long. That's what the early reversal means. And you basically stay long until you cross over and the 80 and come back down below the plus 80 level, which gives you the short, the early reversal short. And we're short until this point, and then we get the crossover from below, we get long. That carries over into the next slide. Now here's the difference. Now here we get an early reversal signal which does not follow through. So far we've been looking at cases where we had the early reversal signal and it followed all the way down below minus 80 and came back up again, working out to a very nice trade. Here we're basically only going down a little bit and then coming back up. Now if this happens, if you go back into the zone above the threshold, above plus 80 in this case, then you get back long. So we get back long here, then we drop below we drop below plus 80 again, and that gives us our early reversal sell, and this time we just stay short through the duration. So that's the early reversal variation. Another way to use the trend weight is to use the size of the trend weight to indicate the size of the position. So when the trend weight is large positive, you'd have a large long position. When it's large negative, you'd have a large short position, and at smaller magnitude numbers, you'd have smaller or partial positions. So as one example of this approach, in this chart, we've put in horizontal lines at 20-point increments, and the idea would be that when you pass the zero line, you'd have a 20% position. As you pass each of the next thresholds, you'd build that position by another 20%, and when you got to the top threshold in the case of a long, which is at 80, you'd have a full 100% position. So as an example of how this would work, we start out, say here, with a full 100% long position, and you can see in this particular case we drop down fairly quickly, reducing that position to actually only 20% by this point, and then going to neutral and moving into the short territory, and quickly dropping down to a maximum 100% short position at this level. And then we maintain that maximum 100% short position for the duration of this downtrend, and begin to scale out of that position right around here, where we drop down to 80 and then 60 and so forth, getting quickly to zero and to a net long position. And at this point, we will have built up to a full 100% long position. That gets scaled out fairly quickly, and the position begins to drop around here. And by this point, we've fully gotten out and gone back short again. Similar pattern here where we go down to a maximum short and then out, scaling out and back to neutral here. And going on to the next slide, in this particular case, we're basically holding a maximum long position of 100% or an 80% position for the duration of this sideways to slightly up trending period. And at this point, we are back and forth in this sideways period, and finally go neutral and drop down very quickly to a maximum short position by this point as we cross the lowest threshold, and here again hold a maximum short position for the entire duration of this downtrend, at least up to the current point in time. So the basic idea of this approach is that we would end up normally holding the largest long or short positions when the trend is in a major move, and when the market is going back and forth, we would be scaling out of those positions and holding lesser positions as the trend goes against the current position. You can also combine two indicators to form one trading methodology. The way this would work is when both indicators are in a buy mode, you'd be long. When they're both in sell mode, you'd be short. And if they're in disagreement, you'd be out of the market. So here we have an example where we've taken the directional weight with a threshold of 20, which is in the upper subplot. And in the lower subplot, we've taken a trend weight with an early reversal and a threshold of 60. Now let's look how this would work in practice. At basically this point here, the first point, we get both signals are short, and so this would be where we would essentially go short. And you can see that both signals remain short until this point here, where we get one going neutral, and so at that point we'd be out. The next point where we get a trade is when they're both in a buy mode, which occurs right here, and that lasts up to this point where the trend weight early reversal signal gets out, and we're basically out of the market again at this point here. We would get short once again when both indicators are short, which is right around here. We'd stay short till about this point here where the trend weight signal goes neutral again. So those last two signals being not far from break even essentially. The next trade we'd get here is where they both go long, and that carries over into the next slide where we essentially stay long until the trend weight goes neutral right around here. So we're out of the market, and we do not get both signals in the same direction until here where we're very briefly for a day or two long, and then they both agree here where we go short in both and essentially stay short pretty much for the duration of the period. So that's an example how you would combine two indicators into a signal trading methodology. Another variation is instead of combining two Jack Schwager indicators, you can combine one of the indicators of your choice with a signal based upon another methodology. And similarly, the idea would be that when both approaches give you a trade in the same direction, you'd be long or short, and when they are not in agreement with each other, you'd be out of the market. Now, a perfect example of this type of application is the dual trend indicator, which we've actually detailed in some previous videos. Now, the dual trend indicator consists of the Jack Schwager trend weight combined with TradeShark's long trend difference. And here we have the dual trend indicator illustrated in the case where we're only taking trades when both signals are in agreement. And so again, looking at the same market example, here you could see where we would be taking positions. We'll start from this point in time where we go from neutral into a short as both indicators are in sell mode, and we would stay short until this point where we have the upper indicator go neutral. And for the rest of this period, you could see there are 4 short-term trades, but most of the period is actually spent out of the market. And moving on to the next slide, during this slightly uptrending sideways period, you could see we're moving back and forth between long and neutral positions, and then we go out during the remainder of the sideways period, and from here on to the end of the chart, we are moving back and forth between shorts and neutral, and being short, of course, when both indicators are short, and being out when they are not in agreement. So that's an example of combining the Jack-Schwager indicator with a signal from another methodology, and an example which is actually part of the Jack-Schwager indicator package as the dual trend indicator. When you use the Jack-Schwager indicators, the exit of the trade will occur when the given indicator moves to neutral or reverses direction, a point that can't be defined ahead of time. So some traders may wish to add a supplemental stop in order to define the maximum risk of the trade. In this case, the exit would occur at the stop point if the stop point was hit before the signal reached a liquidation point. There are advantages and disadvantages in using a supplemental stop. On the advantage side, using such a stop allows a trader to define a maximum risk point. Also, there will be times where there is a reversal in the market and the supplemental stop provides an earlier exit signal and therefore a better exit point. On the drawback side, there will be times where the supplemental stop is hit, but the indicator does not provide a liquidation signal, and the trade then goes on in the original direction. In such cases, the use of the supplemental stop can result in missing out on profitable trades. So it's really up to the trader to decide between those trade-offs whether or not to use a supplemental stop. The Jack-Schwager indicators can provide an exit signal for trades that are placed using an approach that does not embed an exit strategy. As an example, if you believe certain fundamental factors will cause a given market to trend higher or lower over the long run, there is nothing inherent in that methodology that will get you out of the trade, even if the market witnesses a large move in the opposite direction. The Jack-Schwager indicators allow you to take such a trade, assuming of course that it is consistent with the indicator at the time of the trade implementation, knowing that the selected indicator will provide an exit signal if there is a sufficient adverse move. Using the indicator for an exit signal in such cases can help both in riding trends by knowing there is a backstop in case of a market reversal, and in limiting the amount of losses or surrender of open profits. The same 9 trading applications we have just covered for the trend weight would apply to the directional weight as well, but there are 2 important differences I would note. Given thresholds in the directional weight are more restrictive than the same threshold in the trend weight. Because the trend weight combines the trend and the counter trend, the same numeric extreme level, say 80 for example, will occur less often and last for shorter periods in the directional weight than it will for the trend weight. 2, and this is an important caveat, in early reversal mode, it is possible for the directional weight signal to remain long for an extended downtrend or short for an extended uptrend. This is in contrast to the trend weight, which is inherently structured to exit and or reverse on an extended adverse trend. For this reason, the directional weight, when used in early reversal mode, is a particularly suitable candidate for use of a supplemental stop. This is Jack Schwager, and that concludes our review of the various ways the trend weight and directional weight, 2 of my new TradeShark indicators, can be used as trading tools.